Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back. Episode 141 of Carson's Facts versus Feelings. This is after the great philosopher Nelly. It's getting hot in here, Sonu.
Thank you for your attention to this matter.
Yes. all caps. Thank you for your attention to this matter. And it is hot. Like on the YouTube channel, Sonu's sweating. He's just, I hope you make it through. Talk to us. I mean, Chicago got hot and your air conditioning went out. Is that all true?
That doesn't even sound correct. Chicago got hot. Right?
Yeah. It's hot in here, Sonu. It's hot in here.
Yeah. No, I had to replace my AC and, chose to do it today. It's like 95 degrees outside. And I was like, it was fine in the morning. You and I did a morning call. This is June 23rd, a Monday. We're recording this a day early.
You weren't sweating this morning. I know that much. Yeah.
And then into the afternoon, into the evening, it started getting brutal. I'm like, I have my fan going. It's like we're recording this at what's time? We're recording this.
I don't even know.
9 o'clock at night, guys. That's what, people listening to this. But like I said, thank you for your attention to this matter.
Mm-hmm. No, exactly. There's a lot to talk about. We are recording this again Monday evening. What is today? 23rd. And it's just funny. If we would have done this 12 hours ago, it would be different. Who knows if we were recorded Tuesday, but we'll talk about the latest as to what we know with the Middle East. That's some pretty good news all of a sudden. So hopefully it stays there, knock on wood.
I think so.
Yeah, well, we'll see. We'll talk about it. Talk about equities, right? Equities did really, really well on Monday in the face of a surprising lot of people. I'm going to talk about the 3-year itch. I'm going to get into a little bit about that. Then we'll finish it up with the Fed, maybe a little about the economy as well. So, Sonu, obviously over the weekend, we had the United States attack 3 of the nuclear facilities over in Iran. It was eerily similar to Tom Cruise and the plot of the latest Top Gun Maverick, where you had to shoot through this real little area down like a air conditioning. Oh, air conditioning. You ever heard that word before? Air conditioning shaft. I'm just going to use air conditioning to cool you off a little bit. Down a shaft to get inside these bunkers, and it was almost identical to what Tom Cruise had to do in that movie. And obviously, everyone was worried.
And Luke Skywalker.
That's true. Luke Skywalker, as Sonu said, was the very first person to do that. But obviously, concerns, worries, oil spikes. Everyone's worried what's going to happen. Then a little bit of calm and some more news came out, some more events, which I want your take on in a second. But the reality is the S&P 500 on Monday gained over 1%. The VIX almost imploded for the most part. And crude oil, well, it from open to close was down almost 14% since 1975. That is the 6th largest reversal from the open to the close. 14% down. Just like everyone drew it up on Saturday night when all this news was happening. So there's a lot of ways to take this, but what's the latest with the Middle East here?
I think all's well that ends well. Maybe.
Okay.
Hopefully I'm not speaking too soon. But it looks like, I'll rewind back to obviously 12 days ago. I mean, President Trump called this the 12-day war.
Yeah,
is over, right? 12 days, June 10th, which was June 11th, and oil spiked all the way. It was let's just start with oil, right? $65 a barrel. It jumped up to over $75 a barrel. I'm talking about WTI, West Texas Intermediate prices. And today it's back to, I'm looking at my screen here, $65 a barrel. So we've completely reversed everything.
Nothing to see here.
Happened. Yeah. If you were on summer vacation after school graduated and never looked at markets, be like, what's happened? Nothing. And, I can go back to usual programming. But no, like a lot happened, right? And you had the whole bombing runs across into Iran and then Israel. And then over the past weekend, the U.S. got in. And I think, arguably it's to take out Iran's nuclear program. Right. But one thing that always struck me, this was on Sunday when Vice President Vance, your neighbor, I should say.
I believe Vice President Vance lives about 16 minutes away from me. So
Right. Yeah. He was on the Sunday shows and he said, look, we've substantially delayed the development of a nuclear weapon.
Right.
That's the first time I was like, wait a minute. I thought this whole thing was to eliminate all of it. Right. And obviously that didn't happen. And Vance went on to say that their stockpile of enriched uranium is still intact. And arguably that was the reason this whole thing started, because they'd enriched uranium to 60%.
Right.
60% arguably is not needed if you're going to use that for civilian purposes.
Totally. Yeah.
Right. And so, like, wait a minute, why are you enriching uranium to that degree if you're not going to use it for a bomb? And, I think that's why Israel was like, okay, wait, they're not far away from the bomb. We need to attack. Obviously, Israel doesn't have the resources to do it, completely eliminate the program themselves. The US got involved, and then I'm like, wait a minute, now they still have enriched uranium. And then we get the whole drama of, now Iran has to respond. But when they responded, like today was interesting because markets are up about 0.5% on Monday.
Right.
And it was like, okay, everything's fine. Iran's maybe not responding. And suddenly across the wires, you get reports saying, oh, Iran's sending missiles to Qatar. To Qatar, where the US obviously has the largest base in the Middle East. So, but apparently they told the Qataris, we are going to attack. Evacuate.
There were tweets that said this was going to happen. So it wasn't very well hidden, or it was telegraphed, I guess we could say.
And same thing with the US strikes, right? I think Trump's been talking about it for like, maybe I will, maybe I won't, maybe I have 2 weeks. And, like he's been talking about it for several days now. So unless the Iranians don't have access to Twitter or X, or Truth Social, I mean, you think like they would have taken some action. So this whole thing feels very weird about everything seems to have been telegraphed in advance. And now we're like, there's a ceasefire apparently, right? Now, of course, you have a ceasefire only if there's a war, obviously. So, and President Trump tweeted out like, everything is done and God bless Israel, God bless the US, God bless Iran. And,
I don't know what the betting markets had a tweet from him saying God bless Iran this time 48 hours ago, but apparently
God bless the Middle East. And, so here we
are.
Hopefully all's well that ends well. I don't know.
History doesn't repeat itself, but it often rhymes. Mark Twain. I feel like a broken record saying that. But this is somewhat similar to 2020. Remember, the U.S. in Iraq took out one of the top Iranian generals back then, and you knew they had to respond. They had to respond. And if you think back to what happened then, they were launching missiles again at one of the bases. I forget honestly where, but a U.S. base somewhere in the Middle East. Explosions all over. Yeah, probably. But then it was turned out that, the U.S. kind of knew and nobody was there. And then you see what happened this time. And I'm going to read my handwriting if I can read it correctly. Iran retaliated with the exact same number of missiles that the United States sent. So they were saying that's kind of to de-escalate things. And I believe it was 13 of them were intercepted. One of them just kind of went off into the woods and missed. So the reality is, again, everyone kind of knew it was coming because literally there were tweets that said, all the all the airlines were shut down in Qatar. They knew something was going to happen like an hour or two before it happened. The U.S. pretty much knew. So similar to 2020 when they had to retaliate to show some strength, I guess, some fight back. That kind of came and went, fortunately. And again, knock on wood. I've got some wood here. By the way, you know what I also have? A brand new chair. I have a brand new chair I'm sitting in here. It's nice. It's I feel like I slept at a Holiday Inn Express last night with this new chair. My wife said I needed a new chair, so I've got a new chair here. But anyway, anything else? Tom Cruise, Mission Impossible, anything else here about how this is all connected?
I don't know. I feel like, what were we doing all this for? I don't know. I'm very confused. But then these things are always confusing. Yes. I don't know if anyone knows the answer to how much of Iran's facilities were taken out. How far away from the bomb are they? I think at the end of the day, I mean, I'm not saying this should happen or shouldn't happen. Take my opinion out of it, but I feel like if you don't want Iran to get a nuclear bomb, the current regime has to go. Right. And now that's a bigger deal. If you're saying, the Iranian regime has to go, that's a whole different ballgame. It goes beyond just, bombing reactors and centrifuges and things like that, right? So, and doesn't look like anyone's, the U.S. is certainly not prepared to do it right now. I don't think the U.S. wants boots on the ground. But at some point, like I said, they've enriched uranium to 60%, right? The bomb that the U.S. dropped on Hiroshima, I was reading, was enriched to 80%. Little Boy is the name of that bomb. And usually nowadays, you have to enrich uranium to 90% for modern day nuclear weapons, but 60% is getting up there and they still have it. So I'm like, is this just to delay the inevitable, or like, I guess I feel like at some point we'll be back to this, and then we'll just keep cycling through the same exercise every few years, or maybe every 2 years or something. I don't know. But for now, markets have moved past it. Oil prices have completely retraced. What happened since from 12 days ago. The equity market has been going up also, as if nothing happened, right?
Yeah, when everything opened up, I guess it'd be Sunday in the United States, but we were talking on our team and we said, look at that. I mean, most Middle Eastern countries opened up green on I guess their first of the week, but our Sunday, and sure enough, we came back.
Actually, that's a good point on stock.
Well, thank you. Once a year, I have a good point, so I'm glad I finally brought one out.
More than that. But no, look, I think there's a thinking about like, there's war, so equities have to crash, right?
Yeah.
Now, for any country, unless you're just completely wiping out infrastructure, like you just completely like carpet bombing the place. I mean, it goes beyond that, right? I mean, to a first approximation, I was writing about this. War, what does that mean? More spending, more defense spending. And usually that means more deficit spending. All else equal, deficit spending drives aggregate profit growth. I hate to say it this way, but that's good for stocks. I'm not saying war is good or anything like that. Look back to 2003, the Iraq War. At that time, of course, we're coming out of recession. People are like, oh my God, these things are going to crash, all of it, right? And what happened? The S&P 500 gained 29%. Aggregate profits got a boost from larger fiscal deficits. The fiscal deficit in 2002 was 2% of GDP.
Okay.
By the end of 2003, that was about 3.5% of GDP. That's a big increase for the largest economy in the world, right? And that you had more spending. More recently, take the what's the best performing stock market in the world, right?
Israel. It's Israel, up 71%, I believe, since the end of October 2023, which is
incredible.
Again, it's incredible. What I was going to say something. Oh boy, see, it's late. The problem when you do these late at night is I was going to say something and then I totally forgot what I was going to say. But talk to me about Israel. Maybe I'll remember what I was going to say. It was really smart. How's their spending gone? From a deficit point of view, they've really jumped as well, right?
And this is where it's sort of like on first glance, it's very counterintuitive. Wait a minute, you had that terrible attack by Hamas on October 7th, 2023, but then, like you said, from October 31st, 2023, through the end of last week, June 18th, June 20th, Israel's Tel Aviv 125 index is up 71%. Now you say, okay, the S&P 500. Okay, how does that compare? S&P 500 is up 46%. So it's a global bull market. You and I have been talking about that for the last few years. But Israel's clearly outperformed. And it's been the best performing market recently, right? Why? Again, go back. Look at their budget deficit, right? So before the attacks, in 2022, Israel's budget balance was in surplus. So they had a budget surplus of about 0.5% of GDP. By the end of 2023, that became a budget deficit of 4% of GDP. That's a massive shift. You're talking about 4.5% shift. And then by the end of 2024, it was 6.5%. You within 2 years, you went from a budget surplus of 0.5% of GDP to 6.5% deficit, right? That is a massive fiscal impulse. As I said before this morning, actually on a call, buy the fiscal impulse, fade the fear.
No, I actually remember what I was going to say, by the way. I knew I'd get there. Two things. The greatest single year in the history of the Dow was in 1915. It was up 86%. A little thing called World War I was taking place. I didn't know that. I swear I've said this before. You must not listen to what I say, Sonu, but that's
I'm
all
not
right.
listening.
Who knows? Who knows?
My
But
wife tells me that as well.
yeah,
I'd never listen.
I have that exact same. It's funny. No wonder we're friends. I have that exact same problem. Anyway, but 1914, stocks did not do very well as the war broke out. But by 1915, like you said, and here's what I was going to get at. We all remember the late 90s. Stock market did amazing. Major peak in 2000, 2001, 2002. The lows, quote unquote, were October 2002. But for those who remember those time period, we bounced back up and things started going back down again until March 2003. They didn't break the October 2002 lows, but it was one of the longest bear markets. Stocks were cut in half, all that stuff. March 2003 is when the bombs started falling in Iraq. And then what you just said, that caused the end of the massive 3-year bear market, bubble bursting, accounting scandal bear market that we had, in the early aughts, I guess we call it. Early aughts. Yeah, early aughts. Is it aughts? Aughts or
aughts? I think aughts is good.
Yeah. Anyway,
I say 2000s.
We'll just say 2000s. 2000, 2001, 2002, early 2003, and that's again maybe Mr. Market was sniffing out what you just said. All that spending and deficits were coming, which historically can be surprising many a positive for at least equity investors. All right.
I'm sure somebody said this before. Yeah. I'm sure I heard it before. Buy when the bombs start falling or something like that.
I think it was Mark Twain. I'm teasing.
Yeah, it's always Mark Twain.
No, that is one that we've heard before. And, it's there's some truth to that. Well, we've gone 15 minutes, give or take, on this, Sonu. I don't have anything else I really wanted to add. Who knows? By the time people listen to this, I hope some of what we just said is still accurate. Anything else you want to add on this before we kind of move forward?
No. Where do you want to go? What do you want to talk about?
I'd say,
should we go to? There's more drama. There was more drama last week. And it wasn't the Iran thing. It was President Trump was upset with somebody.
We could go to President Trump. I've got year 3. We'll go to President Trump now because the Fed, we'll get into the Fed, but the Fed didn't do anything, right? The Fed left rates where they were. We thought that would be the case. And I've got some quotes from President Trump.
Are you going to read it like a pirate now?
I don't think I'm going to read it like a pirate. I'm just going to read it like Ryan. Here we go. This is President Trump regarding our Fed chairperson, Jerome Powell. We have a stupid person, frankly, at the Fed. Europe had 10 cuts. We've had none. I guess he's a political guy. I don't know. He's a political guy who's not a very smart person, and he's costing the country a fortune. Here we go. Too late, Powell complains about costs, much of which were produced by the Biden fake government, but he could do the biggest and best job for our country by helping lower interest rates. If he reduced them to the number they should be, 1% to 2%. That numbskull, did you have that in your playbook that the president would call that person in charge of the Fed a numbskull? Numbskull will be saving the United States up to $1 trillion a year. Yada, 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 yada. I don't know. I mean, that's kind of, there's more. You understand where it's going. Did you have anything you wanted to add on the fun with remember, it wasn't that long ago President Trump was arguing with Elon Musk, and I guess we're over that one. I guess they're back to being buddies. Now he's mad at the Fed. What's your take on the Fed or this feud we're having now?
One thing that's interesting, and maybe this is because he's a real estate guy. If you ask most people in our business, they're like, oh, how do you bring inflation down? Mm-hmm. You'd say, okay, raise rates, right? Yep. Like most of us would say something like that. But if you ask the person on the street, for the most part, I don't know, people listening to this, right? Like, how do you bring inflation down? Mm-hmm. And I think a lot of them would actually say bring rates down, because when they think are like, oh, things are expensive, interest rates are higher, so things are expensive. It's, a mortgage, for example, costs more. And I think this gets back to Trump in that same tweet. He was like, if he was concerned about inflation or anything else, then all he has to do, he's talking about Powell, all he has to do is bring the rate down.
Interesting.
So there is that element that there's a real estate guy still in there. Higher rates it makes things more expensive. And it's just so different from how all of us in this business, in the investment industry, think about this stuff.
What's the old saying? You can take the boy out of real estate, but you can't take the real estate out of the boy, I believe is how that goes. Yeah.
Anyway, I guess we should talk about the Fed.
Yeah, again, so high level. We didn't expect. We said this on this very podcast, right? By the way, speaking of podcasts, last week we had our good friend Sam Rowe on. Excellent discussion. We went places I didn't expect us to go, but we called it "Going with the Flow" with Sam Rowe. Sam was amazing. Definitely listen to last week's podcast just for a different take on a lot of different things. What's so cool about Sam? He's at the intersection of working with financial advisors and being in the media, being in the news, creating his own company, all the different stuff that is really, really cool. Anyway, so the Fed didn't do anything. Jerome Powell didn't do anything, but it's never that simple, right? When you peel back that onion, what'd you kind of find there, Sonu?
I think that they're stuck. They're in paralysis. And I have my own criticisms of the Fed, obviously. I mean, I think they should have reduced rates.
Yeah.
At least a couple of times by now. I know the tariff thing, and I get that. So I'm not calling Powell a numbskull, but
ask AI? What's a little gentler way to call someone a numbskull? Maybe I'll ask. Maybe I'll find a word while you're talking here. Let's see here. Yeah.
So anyway, in the official statement after the Fed, meeting, they were like, "Okay, we believe uncertainty about the economic outlook has reduced." Right? That's on the face of it a good thing. But they were like, oh, that's only relative to a couple of months ago, post-Liberation Day. They still believe uncertainty is high, right? And that's the main theme behind everything we saw coming out of this meeting. So the Fed moved in, quote unquote, a stagflationary direction. What does that mean? They're projecting higher inflation, they're projecting higher unemployment, and they're projecting lower output or lower real GDP growth, right? Okay. Now, given the core inflation projection, they're projecting it to be higher than 3% by the end of this year. Mm-hmm. You think, okay, they should project a higher Fed funds rate. Now, on the other hand, they projected higher unemployment. So the labor market is going to be worse than it is right now, and lower GDP growth. That would imply more cuts. Net result, they did neither, right? People are basically all over the place. The median projection for 2025 rate projection, I should say, is still at 3.9%. Right now, we are at 4.4, so that's half a basis point, 50 basis points below where it is now. So that means the median Fed member is projecting 2 cuts. And they're only projecting 2 more cuts across 2026 and 2027. So that's interesting by itself, that they think by the end of 2027, the policy rate will be 3.4%. That's only 100 basis points, 1 percentage point lower than it is right now. Right? Remember, the Fed's estimated the neutral rate, the rate that is not too accommodative, not too restrictive, that's 3%. 3.4% is above that, at least by 40, 50 basis points. And what they're telling is that we think policy is going to be on the more restrictive side for the next 3 years. Now, that's the dot plot, right? And then Powell comes out and says, guys, kind of ignore that, right? But because, it's, and I get it, it's point in time, these things can change. We've seen these dot plot projections change, and then there's a reality on the ground which the dot plots are not capturing. But under the hood, right, of the dot plot, there was a shift. Back in March, 4 out of 19 members projected no cuts for 2025. In June, 7 out of 19, that's not a small number, 7 out of 19, right? You get 3 more, and then we get no cuts, right? So 7 out of 19 members projected no cuts at all, right? So there's a wide dispersion, and I think big picture is some of them want cuts, some of them don't want cuts. They're all waiting to see how the tariff inflation will play out. They're pretty, what was baffling to me is that Powell said, as soon as he said it, I was like, wait a minute, what? Why is he saying that? He was like, labor market conditions are currently consistent with maximum employment. I'm like, what data are you seeing? Right? And it's not like they see any hidden data that the rest of us don't see. I know that, right? But they don't see any urgency to act. I mean, they think, okay, the labor market is doing okay. Here I'm looking at it. You and I have talked about it. We've written about it.
Cracking is the word I'd use. There's some cracks.
Continuing claims for unemployment benefits, that's been going up. The unemployment rate, yes, it's not scary high or anything like that. 4.2% on a rounded basis is very low, but it's been going up for 4 months, right? And then you look at non-farm payrolls, that's shifted down. And then most of that growth is coming from non-cyclical sectors. I'm like, things are not hunky-dory.
Right.
But they're like, we're fine. And maybe that's how they're reconciling the fact that, you know what, we're going to keep rates restrictive. We're going to wait for, the data to tell us how tariff inflation's playing out.
Yeah.
But, I'm like, okay, I get the tariff thing. I like, okay, fine. Prices probably will go up a little bit in July and August and maybe into September. But I do think, on the other hand, stuff like shelter inflation will push some of that lower, right? So there is that aspect of it. But still, I think given what's happening in the labor market, they can probably look through any tariff inflation, but they're not. So what matters is what they think, not what I think.
So, a couple things here. You mentioned the word pirates when I talk like a pirate. We actually watched Goonies last weekend. The family did. I don't think my kids have ever seen that. You
I've never
Goonies?
Seen it, but
really,
I've not seen it. Yeah, I know
that wasn't. When did you become a U.S. citizen again officially? When was it? 10 years ago?
2014, 11 years ago.
Honest to God, I'm shocked that wasn't necessary to become a U.S. citizen. I mean, seriously, that should have been like Goonies. You have to watch Goonies to officially become a U.S. citizen. I'm making a joke, everybody.
I love it.
You got to check it out. Though. Anyway, it's pretty funny show. This many years later, my kids liked it. Anyway,
that's going to be my summer project.
Yeah, there you go. Well, it won't take you more than 2 hours. It won't take that long. That's an easy project. I mean, anyway, I was going to say something else. Honest to goodness, that made more sense with all this stuff. Steve Leisman. I love Steve. Great guy. He's like a big Grateful Dead guy, and he plays in a band all the time. He's on CNBC as an economist also. Steve said something along the lines, I'm going to paraphrase it. The Fed's just on hold. They're looking at inflation and they're looking at employment. And whichever one kind of blinks first, that's the direction the Fed's going to go to, with future policy. And you and I already talked about this morning. I loved your answer. What do you think it's going to be?
What if they both go in the wrong direction?
What if it's both? You said, what if it's both? And Steve didn't point that out. I don't know.
What if and by that, I mean, what if inflation goes up to 3%, above 3%? So that's going the wrong direction, clearly.
Yep.
It's nowhere close to 2%, right? And even if you argue that, we're looking past tariff inflation, still 3% inflation is not 2. That's, well above that. And what if the unemployment rate goes to 4.5%, right? I think they prioritize inflation.
Yeah.
And this is where pressure from the president doesn't help. Right. They don't want to be looking as if, at the margin, I think they're like, we need to kind of show we're independent here. Right? Except for the folks who are probably gunning for Powell's job. There are a few folks. I mean, I know Chris Waller. I respect Waller. I don't think he's, it's just about the, like him looking to replace Powell and why he's saying we may cut rates in July. I don't think they're cutting rates in July, by the way. But anyway, he's now calling for that. But this
and Bowman came out today also on Monday and said that. And I believe the odds of a September cut odds. I mean, you would know this before I would, but they're pretty. They're getting up there. They're much higher than they were a week ago, at least. September odds. And I would say 75%. I think I saw that, but I could be wrong. Pretty close for government.
It's about 96. I'm looking at my screen right now. 96% odds of a cut by September.
Wow. Well, that's gone up a good deal then. Okay. All right.
Yeah. And we're talking about 2 cuts fully priced in for 2025 and 20% odds for a third.
Okay.
So pricing shifted, and that's because I think part of that is because what happened with oil, right? Oil came down like it's at 14%. So I think
I would say that's a big. That was a different number when I remember, but that must have all been maybe on oil's historic reversal we saw on Monday.
Maybe over the last hour, for all you know, as we're taping this. But I think going back to what I was saying, because Trump's saying what he is saying about Powell and the Fed.
Oh God, what's he saying now? Oh,
you don't want to know. You don't want to know. Yeah. But I think that we know the general theme of it, right? But I think at the margin that probably makes the Fed wait a little longer. Like they're going to be like, we need to show our independence. And then you get into a situation where the unemployment rate is going the wrong direction. Inflation is going in the wrong direction because of tariffs, not because of oil right now. And they're like, you know what? Central bankers, I think, push comes to shove, they side on the mandate that they have to control inflation.
Yeah,
right?
I think 22 showed us that. I think
Yeah.
22 was a good reminder that people can take a bear market, they can take a recession. What they
Mm-hmm.
really hate is going to the grocery store paying more for items than they once were. I mean, I think that's, yes, there's a
And
dual mandate, but it sure feels like, after 22, everybody looks at that maybe with that
yeah,
tilt toward
and
inflation. I'm with
Powell
you.
said that. I'm paraphrasing as well, but he said that without stable prices,
Hmm.
without inflation under control, you cannot get a labor market that sustains in a good way,
Okay.
right? Which means what? You need to control inflation first.
Yeah.
And I think that's what. But of course, he's going to be Fed chair only through February of next year.
I thought it was May. Is it February? I thought it was
Is it?
May.
It's
One or the
February.
other. I
I think
think
it's
it's
February.
May, but
Is it
I don't
February?
know.
I
Pretty
thought it
sure
was
it's May.
February, but
He started in February 2018, but I thought he had through May. But anyway,
maybe.
whatever.
All right,
We'll
but
get there.
let's find
One
out.
other thing. One other thing you mentioned, like odds and stuff. I wanted to bring this up earlier in the conversation about the Iran and everything going on. There was talk that they might shut down the Strait of Hormuz. Is that how you pronounce it? Hormuz?
Hormuz, yeah, yeah.
Hormuz? Because
Hormuz.
you are the pure expert in the room.
Oh, I don't know
Because
about that.
you you tell us where you grew up first off as a child and in your youth, because you grew up like right there, right?
Yeah, I grew up in Oman, which is so the Strait of Hormuz is
You swam there. You fished there. You've done it all. I have no idea. I don't know
no
that part.
fishing.
But,
I have swam there, but
okay.
well, not
Okay.
not there. I mean, there's tankers, and
I was saying, I don't think I'd want to. Yeah, you want to be anywhere near.
But
No,
the Persian Gulf, right? The Persian Gulf.
No,
I grew up in Oman, a country called Oman, which is
Mhm.
and the Strait of Hormuz. In case somebody isn't, just for reference, it's the narrowest part of the Persian Gulf between the country of Oman on the south and on the north it's Iran, right?
Okay.
Iran nominally sort of controls it, but that's the thing, right? And just because I grew up there, obviously I'm not an expert, but I know my geography. That's about it. Right?
Well, what I was going to get at, I believe over the weekend, it was like 75% chance going to shut it down. As of Monday afternoon, that dropped to like 10%. Now, again, that could be way different when everyone listens to this podcast. But talk to us. I mean, I guess the odds are they're not probably going to shut it down now. But still, what if they did? I mean, the one thing I read, and slept at a Holiday Inn Express last night because I read that about half of all the oil going through there is actually for China and India, which China is a pretty good friend of Iran, last I checked. So if they shut it down, they're almost hurting their friend, maybe even more than the United States. How accurate am I with what I just said?
Yeah, no, absolutely. And it's not just oil, even natural gas. And natural gas from Qatar. Qatar is the second largest producer of natural gas in the world. And a lot of that goes to Asia, right? And it's China and India, by the way. They buy a lot of Iranian oil and natural gas from Qatar and places like that. So 20% of oil that's consumed daily flows through the Persian Gulf. 20% of natural gas is also flows through the Persian Gulf, right? So that is a choke point. But I was always skeptical that Iran would shut it down, not just for this reason, but also the U.S. has enough naval resources. It'd be like a potential shutdown would last few hours, maybe.
Well, that one boat that got stuck a while, or one ship that got stuck a couple years ago, the
on the Red Sea,
on
the
Suez Canal.
Yes.
We didn't kind of fix that in a hurry, but nonetheless, we could
exactly
use some force.
Yeah, totally, right. Like if push comes to shove, the U.S. can do that, right? Because the U.S. has enough resources to do that. So I was skeptical of that, but it goes back to the point about disruption, right? We're living in irrespective of the cause, there is something like every so often now. It's the tariffs. It's this Iran and Israel and this whole Middle East thing, Strait of Hormuz thing. There's always something. It seems like there's a lot of inflation volatility. And you think about, like, they don't have to shut it down, right? Even after all this is gone, you think about shipping costs, insurance costs. I bet oil's gone down all the way. I bet insurance costs for the ships in that area haven't gone down all the way, right?
Okay.
That's going to be still higher, right? So that's the thing. I mean, there could be delays. And then even on the Red Sea, right, you have the Houthis, which are, the border of the Red Sea and that whole area. They've caused enough trouble there for a couple of years. And shipping through the Red Sea is about half of what it was before 2023. Even to this day, it's literally half, which means what? They have to go around South Africa and reroute and all of that. That's made things more expensive, right? Now we probably learn to live with it. Of course, the US is, again, less impacted by that because a lot of the goods passing through the Red Sea goes to Europe, right? So it's from Asia to Europe and maybe the other way to an extent. So again, the US is sort of insulated from that. But it's just a reminder that, we keep seeing more and more of these shocks, or, that's not what we kind of saw in the 2010s when it was like, oh, inflation's way below 2%. Inflation's now
totally.
it's above 2%, and nobody is now talking about inflation going, sticking around at 1.5%, 2%. I mean, I do think before this whole tariff thing, inflation had fully normalized. You and I have talked about that, all of that. But I always thought that was sort of temporary. I always expected, even getting to portfolio construction, right? Our portfolios are constructed, with the belief that inflation will be more volatile over the next few
I'll
years.
jump in. That's what I was going to say. We manage money, right? We manage over about $5 billion approximately in what we call our Carson House View models for our Carson advisors and our Carson partners. And, one thing that we've done, we've talked a lot about being overweight equities, right? And that's fortunately worked. We've talked a lot this year about why we are more looking around the globe than we were in 23, 24, because there's other parts of the globe that are doing really well from an equity point of view, and that's played out. But we have looked at managed futures. We have a little bit of gold in our tactical models. We don't necessarily have energy per se, but if we have inflation volatility, and I like how I don't know if anyone's coined that before, but you have. If we have inflation volatility, sure. If we have another 2022, that's not going to be great. I mean, literally the only thing up was energy for the most part. Gold did okay. We don't anticipate that. But still, if we have some inflation volatility, having a little bit of gold, having a little bit of managed futures, like we do in the models we run for our Carson partners, I think we'll do okay, right?
No, exactly. I mean, even through this crisis, I mean, obviously I'm biased, but we were, at no point did we think, oh, we have to shift something in the portfolios. We're still overweight equities.
Yeah.
We were underweight bonds. We have some duration. We didn't throw it out, right? We have some duration exposure, like long bonds to protect against a deflationary recession. But we also have managed futures. We have gold in there. By the way, we have some cash as well, right? To be opportunistic, right? If we do see an opportunity to go back in a big way, we will, right? A couple of years back, or even forget a couple of years, 6 months ago, we were pedal to the metal in terms of, our overweight to equities. Even before Liberation Day and all that, we'd started pulling back and expecting more volatility. We're still overweight equities, I should say, and we don't expect a recession right now, at least. That could change. But now we have the proverbial dry powder.
Yeah, and I believe I think it's next week's Facts versus Feelings. We'll be joined by Barry Gilbert on our team. I don't know his title. VP, probably like
asset allocation strategist,
portfolio manager, all around good guy, somewhere around there. But Barry, he lives and breathes in our model, so it's gonna be fun to kind of talk to him more about. Join us next week about how to construct a portfolio, especially if you're an advisor. How we're kind of looking at the world construction portfolios again with all the crazy stuff that's happening and kind of where we've been. We review what we just did, and then in 2 weeks. My math is right. My calendar is right. In 2 weeks, we'll release the Carson Investment Research Mid-Year Outlook, and we'll talk about what we kind of see happening the remainder of this year. But I'll be honest, if you listen to this podcast every week, and we know a lot of you do, so thank you very much, you kind of have a clue probably what we're going to be talking about. So how are we doing time-wise? We literally don't have a script. It is like 10:30 Eastern time. I'm exhausted. I got up early. I don't know. Oh, you know how I woke up this morning? Here's what we're going to break this up and wrap it up with. You know how I woke up this morning? Room smelled at about 4:25 in the morning. Okay. Room smelled horrible. I'm talking bad. So Walter, I've talked about him before. Friend of the show. He's probably, I don't see him. He's not down here sleeping right now. But my 140-pound Great Pyrenees. I said, that dog's been on TV more than anybody you know. He literally is 4 feet away from me, just snoring away. I'm talking the judge on CNBC. I mean, that dog's always on TV. And sometimes he's been on this very podcast snoring away. Well, let's just say I think the kids fed him some food, and he had a little bit of, this is PG, but you can imagine what came out. It smelled terrible. And I'm like, being me, I'm like, oh, no. We just trying to, like, put stuff over our faces. We didn't want to clean it up. And
so you knew what it was. Who drew the short straw?
Yeah, it was me eventually, because I always do. So it's been a long day. But anyway, so Walter, he's doing fine now, but that was not the wake up call that I wanted to have this morning,
That
very
sounds
very early. And then
unpleasant in ever so many ways.
it was. And my son Sebastian, he's did his football, so he has to be there like at 6:30 in the morning. So we're getting up pretty early for the summertime. And my wife and I kind of take turns who's going to get up early and take him. And I've got the short straw tomorrow to get up early again to take him. So
whatever happened to summer vacation where you just get a play?
I don't know. I don't know.
I mean, forget us. We obviously working, and here we are, right? Like, 9:30, 10:30 your time, 9:30 my time, Chicago time. But the kids are like, they seem really busy. I'm like, I don't think I was this busy when I was, spending summers as an 8 or 10 year, 11-year old. I mean, I was just doing nothing.
There you go. I mean, Sebastian's going into 9th grade. He had 2.5 hours of football this morning, and he had 3 basketball games this afternoon as well. So that's he started getting leg cramps in the car. So, I remember those days. But enough about that. Let's kind of talk a little bit about equities and then wrap up episode 141 of Carson's Facts versus Feelings. Again, it's titled "It's Getting Hot in Here." And here only has 1 R. If you look at the song by the great philosopher Nelly, it has 2 R's. But the here we're using is only 1 R. Probably can't do 2 R's. Anyway, what was I going to say? This might sound somewhat familiar. One of our big potential worries, we were bullish coming into this year, yes, but there's always worries, always risks. One of them was, hey, this is the 3rd year of a bull market. So we're going to put on the screen the one chart that we're going to share this week because Josh isn't here, so it's easier. The 3rd year historically of bull markets isn't that great. It tends to be choppy on average. And again, my joke about averages is a statistician put his head in a bucket of ice, his feet in the oven. I said, "How do you feel?" He goes, on average, I feel pretty good. So there's my.
I don't know. I could have done with half a bucket of ice for my feet today.
Oh, I know. You still look hot. You still look like you're sweating over there. Up about 2.1% during the 3rd year of a bull market. The 1st year historically has gained about 36%. 2nd year about 15%. So we talked about this literally in our outlook. Came out 6 months ago. Talked about the 3rd year of a bull market can be choppy, can be frustrating. So the 3rd year, by the way, started in October, right? Because this bull market started October 2022. So I think we're kind of through the worst of it with that near bear market that we had in April. We're kind of off to the races, hopefully. But still, it's been frustrating to anybody out there. We talked about, hey, listen, the first half of a post-election year is usually not all that great. First quarter after gaining 20% is usually not all that great. Oh, and it's a 3rd year of a bull market. It can be choppy and frustrating. We're still bullish, yes. We still expect stocks to do pretty well, all things considered, when this year is said and done. On this very podcast, I said multiple times, be on the lookout for a double-digit peak-to-trough correction, mainly because we didn't have one last year. So normally if you don't have one year, you're probably going to have one again, and it probably is going to be some point during the first half of the year. Don't know when. And sure enough, a lot of these things played out. So the fact that the 3rd year of bull market's a little choppy and frustrating isn't surprising, but just know years 4 and 5 tend to do really, really well, and that's something to be excited about. I've got one more I wanted to point out here. I know we're not there yet, but when May is higher and June is higher, when those 2 months historically aren't all that great, but those 2 months aren't all that great, when they're both higher, you tend to have pretty darn good performance. The rest of the year, Sonu, so that's the final 6 months of the year, is up almost 9% on average, higher almost 94% of the time, versus the at any time return the second half of the year of about 5% and higher about 72% of the time. So the only time that the rest of the year was lower was in 2018. So 2018, but that was kind of a Fed policy mistake in December. Market threw a big fit. The rest of the time, and let me just make sure I get the exact number for all the listeners, how many times this has happened. It has happened, what is that? That is...
Is it 6 or
16. 16. So 15 out of 16 times the rest of the year was higher if the month of May and the month of June are higher. June is up over 2.5% the time we're doing this. There's still a week to go with all the headline risk. We get it. But I think just kind of, we call it messages of the markets. I'm an old school John Murphy disciple, if you will. And, are we listening to what the market's telling us? We've been listening for a while, and it's been telling us remain bullish. It's kind of what the market's been telling us if you listen to it. And little clues like that are just more reasons to be optimistic. Sonu, what are maybe another reason or two to be optimistic? And then I'm having trouble even talking anymore. I'm getting so tired. So we might have to shut this down. What else are you watching out there for this week that we should pay attention to, or something to be optimistic about?
I mean, momentum for one thing. And if we do get rate cuts, now, if we do, what's ironic is this is literally what we talked about in our full year outlook, right? What are the opportunities? I mean, the threats have sort of manifested. That's the tariffs. We know that. And we went through that, suffered through that.
Oh, great news. Sorry. Very big news. I just got an email. My complimentary upgrade for my flight tomorrow to Charlotte was just confirmed. So there we go. Somebody sitting in first class. I'm taking an 11:30 flight home. I'm doing a day trip to Charlotte tomorrow. That's why we're doing this podcast day early. So I'll be snoozing in first class with my complimentary upgrade. Thank you, American. I appreciate that. Anyway, sorry, Sonu, just cut you off. Sorry.
No.
Like, that was big. That was big news. I was excited. Yeah.
That's exciting.
Yeah.
What I was saying is opportunities, right?
Mm-hmm.
We could get rate cuts. And now it should have come, arguably, in the first half of the year.
Mm-hmm.
It could still come in the second half of the year. And if it looks like the Fed is looking through tariff inflation, or if it looks like, okay, tariff inflation doesn't look that scary and they can look through it, I think that's an opportunity. And then Congress is going through that whole tax cut bill and things like that. And given what that bill is going to raise deficits by about $3 trillion or something like that, something huge, right? So by itself, remember, this circling back to what we talked about at the top of the podcast, deficits, right? Deficits. Yes, I know rates and stuff. We can talk about that. There is a fear of exploding deficits and what that does to yields, higher for longer, things like that. But short term, that's good for profits, right? That's good for the economy. Right. And especially if you think the deficit is going to go from, it's already huge. It's already like 6% of GDP. But over the next year and a half, if that goes to 7% of GDP, that is a fiscal impulse. Right. And so that's an opportunity here. And by the way, we're only 4 months left for the third year of the bull market to get over, Ryan.
Right, which is good. Like I said, let's get through it. Let's just get through that third year, because usually it's not that great. And obviously this one's been frustrating. I think it'd be interesting, and I know we're not there, not enough time today, but if it has been, what's the stock market do when deficits, increase like you're talking about? Like you just mentioned, it looks like when you have big jumps, it does pretty well. Maybe that's something to dig into a little bit, which again could be a positive here.
Look at 2017 through 2019.
Okay.
Right? It was the first time actually in an expansion, the U.S. deficits actually grew. Usually what happens in it, as the U.S. economy expands, the expansion lengthens. You look at the 90s, even the 2000s to an extent. And 2010s through 2015, 2016, the deficit was starting to get smaller and smaller. Eventually, it turns into a surplus. Back in the 2010s, it didn't, because the deficit hole after 2008 was so big. Yeah. But then after 2016, it just started going back down again, right? And then you think about COVID, right?
Right.
There's a reason why profits came back as fast as it did. And like we've, I think a year ago, a mid-year outlook in 2024, we discussed this. Right. Yep. What drove profit growth soon after COVID? It was basically fiscal stimulus. Right? That was it. And after that, it was investment spending, things like that. But then over the last year and a half, also, what have we seen? We've seen fiscal, stimulus from the IRA, CHIPS Act, Bipartisan Infrastructure Act. All of that was a boost to profits. And so I'm not saying that's the only reason, we got a big bull market, but that helped. Okay. I mean, that on an aggregate level, that boosted profits, right? What is the market like? The market likes profits.
Well, I think our family's helped with ordering DoorDash lately. I think we're trying to do our best to help the economy there too.
Including in London, right? Like, wasn't your...
Yeah,
Sebastian. Wasn't his son ordering?
Well, he didn't. Well, see, I had a credit. I've got a credit card. We use Greenlight, so anywhere he spends money, I've got an app that lets me know immediately. Which, if you have a kid who's, 6th grade, 7th grade, 8th grade, are getting old enough that they're off by themselves, they need some money. Greenlight is a really, really good way to keep track of everything. But he was buying Five Guys burgers like 2 or 3 times a day.
It wasn't DoorDash, right? But
no, the first 3 days he didn't really eat because, anyway, he's a 14-year-old in London. But then he found a Five Guys burger place, and a bunch of them were eating those a couple times a day. But
that's a worry. Like, you give your kid a card or something, and I'm like, wait a
Oh.
minute, it hasn't been used for like 4 or 5 days. Are they starving?
Yeah, that's true too.
But
Yeah.
that's the other side of it.
But they were supposed to give him food, but he didn't like the food they were giving. I paid a ton of money for the food he was supposed to eat. He didn't. He didn't eat it. Anyway, with all of that, everybody, this was hopefully you enjoyed this. There's a lot of different things happening out there. There's a lot of places that you can go to for financial advice and investment advice and portfolio advice. And we're just honored that so many people continue to come every single week to listen to the Facts versus Feelings podcast with Sonu and myself. And to wrap it up again, episode 141. It's getting hot in here. Sonny, you still look like you're sweating a little bit. Is it cooling off at all?
Hot.
I mean,
yeah, it's cooling off a little bit.
Yeah, it's cooling off a little. It's hot all over the place. It's hot, but stay safe, everybody. Stay hydrated, and continue to just believe better times are coming. And we've got some reasons to continue to think that. Again, Barry will join us on our team next week to talk about how he sees the world from kind of a portfolio point of view, managing real money point of view. And then in 2 weeks, we'll release our mid-year outlook. Carson Investment Research's mid-year outlook will be released, and it'll be a lot of fun to talk about how we see the rest of the world, or not the rest of the world, sorry, the rest of the year, potentially. Yeah, year, world, I don't know. Yeah, it's
Same
late.
thing.
Yeah, well, I don't know. I'm tired. With all that, everybody, we'll see you next week, though. Sonu, I'm sure you and I will talk very soon. See everybody next time. Thank you. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.